Hi, Steve Van Metre here. Welcome to your weekly economic update. We take about 30 minutes every Friday to try to make sense of markets that really just don't make any sense. And the topic I wrote about this week had to do with the coronavirus, but I didn't want to write about things that you're normally reading about the infection rate or this that. I want to talk about from a perspective of World Dollar Liquidity what the impact is on the global economy. It's much greater than people actually even realize. And it's interesting when you look at the stock market, and we've talked about this earlier in the week, where people will look at the stock market and say, well, the stock market's up, so it can't be really that bad. Well, yeah, it can, because 80% of this market is computer controlled. And most of those computer programs don't read. They don't. They have a formula that says if these events happen, and have happened over the last, 1 week, 6 months, 2 years, whatever their time frame is, do this. And right now they're on buy because all of them are on buy. This is buy. And they're almost maxed out. We're talking algorithms that in some cases are beyond their maximum normal threshold. I mean, they're adding leverage. They're not just buying stock, they're leveraging themselves up because their formula says, look, at this point, we are at our limit. Take even more risk. So the days are long gone where humans are in control of most of the trading and adjusting stock prices accordingly. Oddly enough, the boomers chased tech stocks up in the 90s. They chased housing prices and stocks up in the mid 2000s. And so they wrote computer programs so they would avoid the downside risk. And not one of them bothered to figure out that if we all write the same central program, we're all crowded in stocks. And guess what? They're all back right where they've been. And we're facing, I don't like the term black swan event for the coronavirus. And I don't like it because if you can't read the news and see that it's bad, I don't know what to tell you. A black swan event is when you wake up on the morning of September 11th and the news telling you a plane has crashed into one of the Twin Towers and another one's on its way. That is a black swan event because you didn't know it was going to happen the night before. Now, if you can't tell me that the coronavirus is going to have an effect on the global economy, it's like, are you paying attention to what's going on in China and other countries? China is the world's largest exporter, and they're shut down. I mean, not entirely, but for the most part, shut down. I mean, we're getting reports this week that oil tankers are sailing up there and being told, go somewhere else. China's oil inventory is almost at its all-time high. I mean, it's really close. They said, well, we don't have people to offload the oil. And if we did, we don't have people to take it to where we need to store it. And if we took it there, we don't have a whole lot of more storage left. And that's just oil. You have factories that are shut down. And they're not going to reopen until the government inspects them. Now, if you're a government-owned factory, great. If you're not, you're going to wait. And even then, there's no guarantee of when that will happen. We don't know how far this thing's going to go, but what we do know is the shutting down the supply chain. And at some point, decades ago, when probably I was a kid, this notion that you should export your labor and everything you can with it to the lowest cost country caught fire as a great idea, and it made U.S. corporations a ton of money. But now we're entirely dependent on exports from countries like China. We can't, if you're building iPhones, you can't just say, well, Foxconn in China shut down. Well, that's okay. Why don't we just throw up a factory over here in Vietnam or somewhere else, Philippines, Thailand? You can't move your production like that. It takes years to change your whole complete supply chain. You just call up a factory and say, hey, I need to build some iPhones. Can you hook me up? It doesn't work like that. And so you look at the stock market today and you see everything looks cool. It looks cool until it doesn't, because when you're at the end of the supply, we're at the end of the supply chain. As Americans, we think, we're at the front of the line. We're like, we lead the world. Okay, yeah, we do in a lot of cases, but in the supply chain, we're at the end. When the first parts come in to assemble anything that's in China, it's not like we're sending them. They're manufactured somewhere else. We do send, chips over or some other components that are manufactured here, and they're assembled there. We don't get it till the end. So let's say all the exporting in the world stopped tomorrow, we wouldn't know it. As Americans, we would know because we still go to the store. We still see stuff on the shelf. There would still be stuff that's in port. There would still be stuff that's on container ships. We don't know till it's bad. And so you can look right now at the cratering data coming out of China. You're like, well, that's pretty ugly. It is. It's coming here. It's coming here. Europe was already slowing down. We started to slow down. And people think, oh, this cannot affect us. It's amazing to me. And I keep saying, every week this thing goes on, it gets worse and worse and worse. Because the issue is not, the global trade is just slowing down. The issue is when you have the most indebted world economy in history, which we do, and as the United States and as the world, we have the weakest growth of any economic cycle in history, you need dollars to pay on those debts. And how do dollars get created? Well, they get created through lending. But what's the biggest way that occurs is through the World Dollar Liquidity cycle, through global trade. When we buy foreign goods, then that creates more demand for dollars and the total pool of dollars expands. So you have two issues, and that's why I wanted to write about this week, is one, you have, and I didn't see anybody talking about this, which is kind of odd to me. You think this would be really what people would focus on. Is one, you had the Fed engineered the world's largest contraction of world dollar liquidity when they tightened, or they raised federal funds rate and tightened monetary policy by unwinding their balance sheet, starting December 15th, December 30th, 2015. Now you have a second issue. Remember the economy you're talking about is really weak to begin with. The lending, everything says it's really weak. And the first domino, this whole thing is wobbling. It just needs a little nudge. And now you have the world's largest exporter. And this is not just going to affect China. It's going to affect other nations, because let's say that you have an automotive plant in South Korea, which is, some of them are shut down temporarily. Well, why would they be shut down? Well, maybe they need a part or several parts to build their cars that are only built in China. Well, they can't get the parts when they run out of inventory. That's it. It's done. Turn the thing off. If they were smart, they'd have a backup plan, but if they're not, they don't. And there are some things, like aircraft parts, you don't have duplicate supply chains for. There are some components that are so precise, so specific, you would not spend the money to have a duplicate supply chain or a backup out there. This is going to have major repercussions, and as Americans, we haven't seen them. And it concerns me because people are taking risks as if there's nothing wrong in the world. And when this eventually flows into the United States economic data, people are going to be shocked. They're going to. Let's take a look at the economic data from this week. Let's look at the asset. I want to look at the assets and liabilities of commercial banks, then we'll go on to the slide deck. So here we have Treasury, securities and bank credit rose, okay, about $9 billion, almost 10. And where did that come from? A small chunk in mortgage-backed security. Well, here we go. $6 billion in mortgage-backed securities. Notably, despite Treasury yields falling, which again, mortgage-backed securities are the second best thing in bond world as government-backed securities to Treasury. But Treasury securities, they shed $3 billion, but yields fell, and we'll take a look at that. Again, this is week ending February 5th, so this is a little behind, so we'll go take a look at that. And we see a change here in, we got an increase in non-government-backed mortgage-backed securities and a little bit increase in non-Treasury securities of whatever these type of bonds are. Total loans and leases, we're seeing some credit expansion, which is good. In a debt-based economy, you want to see credit expand by $11 billion. Let's take a look. It really did not come from commercial industrial lending. This thing is flatlined, and you can see it's at $2.35 trillion, and it hasn't really gone a whole lot since. It's actually down from its peak back in August, so it hasn't really gone anywhere. Now, real estate loans rose by $4 billion, which we would expect that to happen. Why? Because we're seeing refinances. And maybe if we looked in here, residential real estate loans, so you're not seeing people taking out home equity loans. Maybe they're starting to refi those home equity loans. I do expect this to rise, mainly just due to the increase in refinances. Commercial lending rose about $5 billion. Consumer loans were flat. I'm curious to see if we see credit cards go down. They went down $1 billion. I'm curious to see if some of this flows up into some real estate loans. Automobile lending is virtually flat, telling us there's not much growth in the automobile world. And so from a lending perspective, not a whole lot of action here at all. But let's take a look at the slide deck and see what we've got going on here. We've got, oops, I'm on the wrong slide. M2 money supply, growth rate flat at 7.14%. We're seeing some money come out of money market funds, but it's certainly not impacting Treasury yields. 6-month rate of change is flat. 3-month rate of change is falling slightly. Again, this is all puffed up by the Fed's not quantitative easing program. Take a look at real estate loans. Now, this is some heavy revision on this over last week. Growth rate is up to 4.5%, and you see Treasury yields are right near their all-time low. They're heading lower. And real estate loans are ticking up. And again, we should expect that with this huge surge in refinances, but if those refinances are not going out into new spending, and I don't believe they are, if they're just going to extend the term and to pay off consolidate other debt, it's meaningless. In a debt-based economy, you need new lending that going into new consumption. So if you said everyone was going to take money out and go buy, say, a new Audi from my son, who would be super thrilled about that, then yeah, that would be great. But if it's just refinancing existing credit card debt, it means nothing. So growth rate is up to 4.5% from this time last year. Still not stellar, but it finally cracked 4%. Hasn't done that in a long time. And 6-month rate of change is rising. 3-month rate of change is rising. Again, expected, but not very strong for how low mortgage rates are. Commercial industrial lending virtually flat, just at over 1%. The 6-month rate of change is really quite falling at almost 1%. This has been a red flag when you see this, but this will tick up unless there is a drop down. If commercial lending just stays flat, and I don't think it will, because think about why do people buy or borrow money on a commercial level? Well, they're financing inventory, financing other purchases, financing things that they're going to sell. So with global trade slowing down, I would expect that this is going to as well. 3-month rate changes up a little bit, but effectively flat, and we're almost at 0% for the year. So I imagine here in a couple months we should see this drop to zero, and that number doesn't usually happen until we're actually in a recession. And you remember the last time commercial industrial lending got this low, the stock market was barfed all over itself. Not seeing that yet, but I suspect we will at some point. Loans and leases and bank credit represent 1/3 of all total lending in the country. Growth rate is flat at 4.18%, so you're seeing an offset between the commercial lending and real estate lending and all the other stuff. 6-month rate of change is rising. The 3-month rate of change is rising, but still not at any impressive numbers. They're just virtually saying that, yeah, this is about right. I mean, there's nothing down here that's really suggesting that this number is going to shoot higher. Credit card lending growth rate down to 4.39. So again, slowing there. Banks are tightening their credit card lending standards, and interest rates on credit cards still remain quite high. Now I want to revisit World Dollar Liquidity and show you what the problem is. Now these arrows are going the wrong way. I didn't realize it, and I tried to turn them the other direction, and can't. So rather than retype everything, I just decided we'll go backwards. So consumers demand foreign goods. They go and they buy foreign goods, and those dollars flow to foreign companies. So those dollars go there. Foreign companies keep their hands on some of these. So what is World Dollar Liquidity? For those of you who've never seen this is how dollars are created. Why global trade is so important. Why countries like China really do matter now. And 10 years ago, 20 years ago, they didn't matter as much, but today they're a much greater integral piece of the world dollar liquidity cycle and the global economy, not just from the size of their country, but from what they do as an exporter. So dollars flow over to foreign companies. Now they might keep some of them because they might need to go out and buy oil or other things that are traded in dollars. But those dollars they don't need, which would be most of them, are exchanged to their bank, which eventually flow up to the country's foreign central bank. And that is exchanged back for local currency. So if I'm in China, I will take my dollars, go to the bank, and I'll get renminbi back so I can pay my employees, and the central bank will pile up U.S. dollars. And when the U.S. dollars pile up in a foreign central bank, they are inflationary. So to get rid of the inflationary effects, foreign central bank will buy U.S. Treasury securities, generally at auction, for one of the many auctions that the U.S. Treasury offers. And what happens now is you see a small multiplication of dollars here, because you have $1 here that's going and buying or let's say $1,000 get you a Treasury note. So you go buy a 10-year Treasury note. Now, are you getting some interest on that? Yes. So $1 is going here, but new dollars are being created by the interest payment, but not a lot, but new. Again, you were talking about inflation. This is one of the reasons why low interest rates are not inflationary, because you want high inflation. Well, What if 10-year Treasury is paying 10%? That's inflationary because now foreign central banks are piling up more dollars. So they would need to buy more debt. So people say low interest rates are inflationary. They are not. They are inflationary only at the point of which they lead to an increase in lending demand. So anyways, so there's a small increase in dollars here. Now, the foreign central banks buying these U.S. Treasury securities, and that goes to the U.S. Treasury, and then the government spends that money out into the real economy. Now, most of it will go out to the United States, and it will go everywhere. It goes Social Security, Medicare, into running the government, military. It does get spread all over the world, but most of it's going to get spread back into the United States, where it hopes U.S. consumers borrow money. There's a key point here that's not here, but when consumers buy foreign goods, hopefully they're not just buying it with cash. Excuse me, they're buying it. Just keep in mind, for those of you who are wondering, I'm still a bit sick, and no, I do not edit. I think it's powerful. You actually get my thoughts at this time without me chopping this thing up 9 ways a Sunday. So again, you get borrowing here when consumers buy foreign goods, and the borrowing creates more dollars and the cycle goes. Now, how is this going to be affected by the coronavirus? Well, you notice it drew an X through consumers buying foreign goods. Now, it doesn't mean that someone won't want a foreign good. For example, Apple sells some wireless earbuds. I don't know exactly what they're called because I don't own any Apple products, but I am aware that they're completely out of stock. So if you do find them, that's it. Why? Because the factories in China where those headphones are produced are closed. They're shut down at the moment. So consumers can't buy foreign goods, and that starts to constrict the world dollar liquidity cycle, which in turn puts more pressure on the Federal Reserve to ease. He said, well, that has to be inflationary, Steve. No. Quantitative easing is not inflationary, even though everyone thinks it is not. And if you need some more evidence, then how is it that 10-year Treasury yields are lower than they were when the Fed started the easing process? They have 3 rate cuts and a ton of easing, and interest rates are lower. They're lower than they were in the great financial crisis. So you cannot tell me that quantitative easing is inflationary. It's inflationary when it leads to lending growth. And why do we look at lending data every week? We're looking for it, right? If you want to know where the markets are headed, it's real simple. When lending growth is slowing and falling, you get deflationary shocks in the market. And how do you fix that? You need to create more dollars. So how do you create more dollars in a debt-based economy? You lower interest rates, right? Think about this. If interest rates went to 10% tomorrow, are you going to go borrow and do anything? No. You're not going to go borrow and buy a car at 10% interest unless you have no other options. So you need lower interest rates. So what does quantitative easing actually do is it pushes rates down. Now it's pushing up against the federal funds rate. It's trying to get the Fed to lower it. And that's why you hear people like myself talk about inverted yield curves. And when we look at why are 10-year Treasury yields just above the lower bound of the federal funds rate. Now, what do I mean by that? The federal funds rate is between 1.5% and 1.75%. 10-year Treasury yield is under 1.6. It's 1.5 something. I don't know where it closed today exactly. But what happens is when the 10-year Treasury, as a 10-year Treasury yield pushes below, and I believe 7-year and everything else is all under. So as 10-year Treasury yields fall below the federal funds rate, it puts pressure on the Fed to cut interest rates. You see, the monetary system that guides, that creates all these dollars is effectively telling the world, I don't have enough dollars. The monetary system is a dollar addict. Think of it as a dollar addict, right? They don't take a pill, they don't snort anything, they're not shooting anything, they're just addicted. They don't drink it, they don't eat it. It just wants it, just craves the creation of dollars. And so when the Fed had the largest contraction of world dollar liquidity, and now you have the coronavirus attacking on top of that by literally shutting down the world's largest exporter. The monetary system needs dollars, and it needs them if you want your stock price to stay up, if you want your home price to stay up, if you want your business valuation to stay up, if you want all these things to be worth what you think they are worth and maybe what you just paid for them, then you need the system to create dollars. But when the Fed does not lower interest rates or do enough quantitative easing to lower interest rates enough to spur that creation of demand and lending, the system will eventually break. That's how every recession occurs. The system says, fine, I want X number of dollars and I want them to grow at this rate a year, and you will only give me so much, so I'm going to shrink the economy down. I'm going to shrink it down until you give me what I want. That's how recessions occur. So the issue isn't that we aren't going to have another. It's only a matter of when and how severe. And with the coronavirus, it does set the stage. This could be much worse than people think. And I'm not saying that for all the unfortunate people who are dying from it, who are sick from it, who families are affected by it, who have been stranded from it, and those things are terrible. I'm telling you this from an issue of the global economy. This is not something the system was designed to get fixed. Not when it's still reeling from the Federal Reserve. And you're seeing nothing is being generated from the Fed's easing other than people speculating on stock prices, and we know exactly how that ends. Because when as the system contracts, stock prices will blow up and crash. That's how it works, how it always happens. Nothing ever changes, just kind of the players do. Let's take a look at the NASDAQ McClellan Summation Index proxy liquidity. We're seeing liquidity kind of slow down despite stocks sitting near their all-time high. It's an indication that financial conditions, are starting to tighten. We'd love to see this thing just tank and get below 300 and have a nice big deep sell-off to take advantage of and see bond prices go up. And that is not far off. Not far off at all. Let's take a look at, I want to spend the next 10 minutes just looking at charts. I know we don't do that as much as I'd like to. So I'm going to spend the rest of Valentine's Day update looking at charts. So the VIX was trying to hold its 200-day moving average, didn't. Trying to hold its 100 or 150-day, didn't. It's forming this downward kind of wedge pattern. Usually these things end up spiking up higher. And we know financial conditions are tightening. Why? Because interest rates are falling. Now, keep in mind, these are not the closing value. I don't know what the closing value was. I'm recording this a bit later than normal. But what we see, I drew this line here. So we're in this triangular pattern. I didn't bother drawing the line up here. So what's happened today is yields went down and are starting to squeeze all the people who were short here and here out. And then they're squeezing the people that are short here. And what it suggests is when it breaks this dotted line, just like it broke here, now it puts the heavy squeeze on the people that were shorting right down in here, and it starts to squeeze these. And now you are looking at a quick return to the big line in the sand at 1.4% on 10-year Treasury yields. And why does that matter? Because you have a triple bottom, and it may bounce here, but don't expect it to last long, because this is the largest topping pattern in the history of the 10-year Treasury yields. So you have 1, 2, 3 bottoms. Usually don't have 4. If you do have 4, don't hold your breath. It is not going to last long. And when you have falling Treasury yields, it tells you financial conditions are tightening. And we know that because the coronavirus is tightening on top of the already weak global economy. So this sets up the stage for a huge drop in Treasury yields. Let's take a look at 30-year yields. And they dipped briefly below their dotted line today, and I thought, their sellers are going to fight back. They have to, because those who are short up here and short here are immediately in the loss. Now we'll look on Tuesday, which we'll get over the weekend, but markets close on Monday, so we'll look at maybe Wednesday. We'll just see what's going on. Whatever the next video is going to be, probably Wednesday, how the speculators are positioned, because if they added to their shorts, which I'm hoping they did, it even puts more velocity on this move down when it happens. So if we take a look at TLT, which is the 20-plus year Treasury ETF, the largest traded one, you see here's this triangular pattern. We see this kind of here and here. We see it trying to break out above this. Now, what's really interesting today, if we go and zoom in at the 10-day, what we see is yields went down to right, and it was checking in. You can see it went down and just popped up right before close. But what it was looking for right in here, it was checking in. See these prior levels right here? It was checking, it's forming a new layer of support here. So what the market is trying to find out, and I knew it was going to dip today a bit, and I say that tongue in cheek because you never know where the market's going, of course. But why were yields forced to go down? Well, one, they ran into resistance right up here. See, they ran into these sellers here, who we already know are sellers over here and sellers of some other place. And so what the market was finding out is, do you people that sold here, or do you want to sell? The answer was yes. And then it went down to this level right here, and in here, and right in here, and said, hey, do any of you people want to sell, or are you good? And what we learned today is at the moment, they're good. So what that is suggesting is we're going to see a move higher here, squeeze out these people, and find out maybe not even squeeze them, maybe just put the pressure on them to see if all these people that were short want to be short again. But we look at volume today, we look at the price move today, we don't necessarily see that that is what they're up to. Let's take a look at ExxonMobil. Again, I'm not picking, when I just want to let you know, when I look at individual stocks, not only do I not have a market in any of them, I have no beef with any of these companies. I'm picking on ExxonMobil as practically a proxy for every oil stock on the market. So let's take a look. ExxonMobil is flirting with $60 a barrel. The reason this is, or $60 a share, definitely not a barrel. The last big point of buyers was right here in this, $58 to $60 range. This is a major area of support. It goes back to 2010 and then 2005. Now, what happens if there are buyers here, which there doesn't look like there's many of, then it says the people that bought in 2010 and 2005 are still holding on to their positions and want to add to them. If we do not hold this position here, and I'm going to guess that we don't, what you're going to learn is the people that bought here sold up in here. They were all sellers up in here. And we might then also learn at the same time that the people that bought in 2005 already sold as well. So maybe the people that bought in 5 and 10 sold all the way through here. And if that happens, now you go down to the next place of where there is support. And that for ExxonMobil isn't really until you get down here into the low 40s. So the question is, are these people that bought in here still good? And if not, then you're seeing ExxonMobil down into the potentially the low 30s, and then who knows where it goes from there. But this is very critical for ExxonMobil. Now we can look at Chevron, and Chevron's very interesting too. And it had this wedge pattern, and you can see it broke through this wedge, and maybe the people that were buying back in 2018 decided that that was a good point to buy, and it came back up and it hit this lower purple line. And it's being rejected there. Why? Because what it's finding out is the people that bought in here, so we go straight across now, the people that bought here in 2019, the people that bought here in 2019, the people that bought back in 2018 don't appear to be buyers anymore. And so when you see prices break through a structure like this, they'll often come back, often, not always, but often come back and reconfirm. Just say, hey, we came down and some of us bought. Anyone with us? The answer is no. Then it's going to reverse down. And for Chevron, its next layer of support is right here around 102. This kind of band between 100 and 102. And unless these people down here that were buyers back in 2016 want to buy some more, then the next destination for Chevron, because you don't, look, you see what's in here. You see selling because it went up and it sold down. You don't see buying now until Chevron's back down into the 80s. Yikes. And you can see some of this translate through these two married together in the largest energy ETF, wherever it is up here, XLE. And you can see that beautifully here. So you can see it's right now the prices are trying to figure out, are the people that bought here in 2016 and 2010 still buyers? If not, now you're down here into this big chunk back into the great financial crisis of 2008. And if not there, you're really almost looking like this thing is going to get back down into the 30s. You're talking about losing, going from a peak of 100 down potentially in the 30s. Whew. And speaking of things that don't look good, small oil producers, the symbol XOP, briefly made a new all-time low today, did not close there. But this is telling you these small oil producers are headed to near zero. There's going to be a lot of opportunity in the oil sector, but not today. Let's take a look at ag commodities. If you don't believe in head and shoulder, I show you this because technical analysis does matter, where buyers and sellers do matter. Here is a left shoulder head, right shoulder. This is forming a major bottom here, and it's running into a little headwind here, but it's not quite over, but we see that prices are still trying to move higher. So that's positive for ag commodities. Let's take a look at some other stocks. Definitely don't want to look at Tesla. How about Boeing? This is really interesting. You look at Boeing and you see this huge, massive top. And what it says, and we'll zoom in a little bit. I like this chart a little bit better, is there were buyers here at around 3 to 320, but they ran out of steam real quick. So the question is we know a lot of the executives sold. And the reason is, how do you know prices are going down. Well, I don't happen to have intimate knowledge of Chevron or Exxon or Boeing, but I do know there are reports every week of insiders selling, and you can go look and see that insiders have been selling these companies. In fact, insiders have been selling from all the major companies, and wait till retail investors find that out, that the market they think is going higher isn't, because all the people that know more about the company than anyone have been net sellers. So you see Boeing bounced up here and is running into resistance and making a lower high, again suggesting at some point it's going to break this 315 level, and Boeing's got a long way down to go. Now crude oil, so we've been on an energy theme here, went back up to 52 a barrel. Why does that matter? Because 52 is now overhead resistance. So you can see where there have been buyers before. So it's going up and saying, hey, all you guys that were really excited about buying here, are you in? Are you back? It doesn't quite look like it. We can zoom in today and see, this is just sitting right under, you can see it's trying. Buyers, no. How about now? No. How about now? No. How about now? Again, you knock the door enough times, you break through. But the question is, are there any buyers there? If not, again, that tells you that oil is headed back down to 42 a barrel. So anyways, maybe we'll look at some other charts in next week. So again, I'm Steve Van Metre. Appreciate you taking the time to watch. I hope you and your loved ones have a wonderful Valentine's Day. And I am going to read you a disclosure and get out of here. The content of this video is provided as educational informational. It is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by selling security and financial instrument or participating in particular trading strategies. It was paired by Steven Van Metre. Personal capacity opinions expressed via that one do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.